If you call a major commercial bank at, say, 10:35 at night on a Thursday, you are going to get an automated system telling you to call back during normal business hours on Monday.
Right. The machine hangs up on you, and that's it. You just go to sleep.
Exactly. But today, we are looking at a financial anomaly. We're talking about a highly successful mortgage operation where that exact late-night phone call doesn't just get answered by a human being.
Which is wild in itself.
It is, and it actually legally locks in a market rate that saves the caller tens of thousands of dollars over the life of their loan.
We're deconstructing the mechanics of how top-tier professionals operate in really one of the most high-stress, high-stakes industries in the world.
Oh, absolutely.
So whether you are prepping to buy your very first home or looking to scale a massive real estate investment portfolio, or honestly, if you are just insanely curious about the hidden architecture of the real estate market, this deep dive is custom tailored for you.
Our mission today is to tear down the engine of a specific case study to see exactly how it runs. We're focusing on Village Mortgage, and specifically a mortgage broker named Timothy Joe, based out of Glendora, California.
Yeah, and the stack of sources we have for this one is pretty fascinating.
It really is. We are pulling from the official Village Mortgage website, which, gives us the structural blueprint of their operation and their product inventory. We also have their Yelp profile, which boasts a flawless 5.0 rating across 114 reviews.
Which is, let's be real, in the deeply emotional, highly volatile financial services world, a perfect 5-star sweep across that many clients is practically a statistical impossibility.
Seriously, people love to complain about their mortgages.
They do. Oh, and we also attempted to pull some broader context from a National Reverse Mortgage Lenders Association site, but we hit a bit of a brick wall there.
We did. We were blocked by a Cloudflare attention required error.
The classic.
The dreaded root ID 9E02D8 BFF BBD738.
A true classic of the internet.
Truly. But honestly, the Village Mortgage site and that Yelp profile provided an absolute goldmine of data on their own. It gave us this perfect window into how this business actually functions on a day-to-day basis. So, okay, let's unpack this.
Let's do it.
To really understand how a broker earns 114 5-star reviews, we first have to understand the structural advantage of their business model compared to a traditional retail bank.
Right, because the architecture of the business completely dictates the client experience. On his Yelp About the Business section, Timothy Joe actually outlines the structural advantage really clearly.
Yeah, he does.
He operates as both a direct lender and a mortgage broker. His NMLS number is 1618030 for those keeping track at home. But the critical data point here is that he is contracted with 100 different banks, credit unions, and wholesale lenders.
100, which is just a massive number. The sources point out the contrast here. Like if you walk into a major retail branch, let's say a Chase or a Wells Fargo, you are only ever going to be offered their specific proprietary products.
Right, you get the Chase loan or the Wells Fargo loan.
Exactly. You sit at their desk, they look at your file, and they give you the single rate their internal underwriters approved for that day. It's take it or leave it. Village Mortgage operates on a completely different paradigm.
Yeah, it's basically the flight aggregator model.
Right. They take your single application and essentially syndicate it out, putting it up against dozens and dozens of lenders simultaneously to find the absolute floor of the current interest rate market.
What's fascinating here is how this structure fundamentally shifts the heavy lifting. In a traditional banking scenario, the consumer bears the burden of discovery.
Oh, 100%.
If you want to accurately compare 3 different rates to ensure you aren't being overcharged, you're filling out 3 massive invasive applications.
And digging up your tax returns 3 times.
Yes. And you're authorizing 3 separate hard pulls on your credit report, which can actually damage your score. Plus, you are managing communications with 3 different loan officers who are all incentivized to sell you their specific product.
It's the illusion of choice versus actual market leverage. And I have to push back on this 100 lender model for a second.
Sure.
I'm looking at this from an operational standpoint, and frankly, having 100 different lending partners sounds like an absolute administrative nightmare.
Oh, it has to be.
Right. Every single one of those banks is going to have its own proprietary underwriting portal, its own unique API integrations, its own weird internal compliance quirks. If I'm the client, a broker juggling 100 different back-end systems sounds like a recipe for my file getting lost in the shuffle.
It is incredibly complex on the back end, I agree. But that complexity is exactly the foundation of their value proposition.
How so?
Well, the broker deliberately absorbs that administrative nightmare so you never even see it. Think of it as renting their operational bandwidth.
Oh, I like that framing.
Yeah, you aren't just paying a broker for access to capital. You are paying them to act as a highly efficient filter against institutional chaos. They navigate the disparate underwriting portals, they translate the various compliance quirks, and they just deliver a clean, executable contract to your inbox.
Okay, that makes sense. But having that massive inventory of 100 lenders at your disposal actually creates a secondary challenge.
Which is,
Well, if you have access to the absolute best rates across 100 different institutions, you have to actually be awake to catch them. Market rates fluctuate constantly based on bond yields, inflation reports, Federal Reserve whispers.
they change by the hour sometimes.
Exactly, which explains the most jarring, highly unusual detail we found on their Yelp profile.
You're talking about the stated business hours.
Here's where it gets really interesting. Village Mortgage lists its hours as open 24 hours every single day of the week, Monday through Sunday, 24 hours a day.
Which just sounds like a typo.
Right. I initially assumed the 24 hours listing was just a marketing gimmick or a mistake on the Yelp page. And just as a side note to show how wildly flexible this operation is, they officially list that they accept cryptocurrency and cash alongside standard credit cards.
That's incredibly rare for a mortgage broker. But going back to the hours, the reviews completely validate the claim.
They do. A client named Jenny L. from Los Angeles specifically highlighted that Timothy was answering texts and actively working her file well outside of regular working hours.
And then we have the scenario you mentioned at the very beginning of this deep dive.
Yes, Peter L. from Monterey Park. He left a review stating he called the office at 10:35 p.m. on a Thursday. And he even admitted in his review that he was terrified of being yelled at for calling a financial professional that late at night.
I would be too.
Right. But Tim warmly greeted him and casually mentioned that 11 p.m. phone calls are actually very common for his operation.
I mean, in traditional finance, 11 p.m. availability is completely non-existent.
Which is why I'm looking at this 24/7 availability and seeing a massive liability.
A liability.
Yeah. If I'm a client, a broker who never sleeps sounds like someone who is eventually going to make a fatigue-induced math error on my closing documents. Like, setting an expectation that you are always on call is a fast track to severe professional burnout. How is this a sustainable business practice? Is it like an ER doctor on call?
To understand why it's sustainable, we have to do the math on Peter's late-night phone call.
Yeah.
This wasn't just a broker providing a friendly chat to soothe a nervous buyer. Let's look at the actual numbers Peter shared.
Okay, let's hear them.
Because Tim was available to execute the rate lock right then and there, Peter secured a 5.875% interest rate on a $300,000 30-year loan. And Peter explicitly noted that a competing company was offering him a 6.25% rate with the exact same points and fees.
Wow. Let's break down what that fraction of a percentage actually means in the real world. Over a 30-year timeline, the difference between a 5.875% rate and a 6.25% rate on a $300,000 principal is massive.
It adds up fast.
You are looking at a difference of roughly $75 to $80 every single month in pure interest. Over the 360 months of that loan, that late-night phone call literally saved Peter over $25,000.
If we connect this to the bigger picture, you see why the 24/7 model isn't a liability. It is the ultimate competitive edge. Mortgage rates are intrinsically tied to mortgage-backed securities traded on the bond market. Those markets shift rapidly.
Oh, yeah.
A highly favorable rate might only exist for a 4-hour window before the market corrects.
Right.
If your broker clocks out at 5 p.m. on a Friday and a massive dip happens on a Friday evening or over the weekend in response to global news, you just missed the window.
That's brutal. Imagine you are the one staring at that $300,000 loan. If your broker is strictly working banking hours, you are the one paying an extra $25,000 in interest simply because they weren't at their desk to click a button.
Exactly.
The emotional weight of that is staggering. A mortgage is often the largest, most consequential financial transaction of a person's life. The sheer terror of taking on $500,000 in debt requires a level of reassurance that a 9-to-5 automated portal just cannot provide.
But here's the thing. Answering the phone at 11 p.m. to lock in a rate is highly effective, but it is ultimately a reactive service. You're reacting to the client's immediate anxiety or a sudden market shift.
That's a good point.
What truly separates a functional brokerage from a Tier 1 operation with 114 five-star reviews is what the broker does when the client is entirely silent.
Oh, you're talking about the shift from reactive firefighting to proactive surveillance. Reviewer after reviewer highlighted this specific trait. MEB from Glendora praised Village Mortgage for implementing a system that actively monitors the market and sends out notifications the moment rates drop below the client's current active mortgage rate.
Which is incredible.
It mathematically signals exactly when a refinance makes financial sense without the client ever having to check the news or worry about it. It's like having a financial weather forecaster who taps you on the shoulder and tells you the exact day to harvest your crops.
Arnold J. from Cerritos detailed this exact experience in his review. He didn't even initiate a refinance. Timothy reached out to him proactively when the rate environment shifted, running the amortization schedule in advance to show Arnold exactly how much interest he would save by restructuring the loan.
We also saw this proactive urgency applied to the actual closing process. Natalie L. from Torrance outlined a scenario where Village Mortgage implemented a credit repair plan, perfectly timed a falling rate environment, and executed a remarkably fast closing in just 3 weeks.
3 weeks is fast. But Armand C. from Monterey Park had an even more extreme timeline. He closed his loan in just 15 days.
15 days. That kind of velocity in real estate requires anticipating underwriting conditions before the bank even asks for them. And speaking of anticipating problems, MEB also mentioned getting proactive help navigating new SB 326 regulations.
Yeah, SB 326 is a California state law requiring specific exterior elevated element inspections like balconies for condominium complexes.
Oh, wow.
It's a highly localized, highly specific compliance hurdle.
Which proves the broker isn't just watching federal interest rates. They are actively monitoring local municipal codes that could completely derail a client's escrow. But wait, let's look at the business logic of this proactive surveillance for a second.
Okay.
Once a broker closes a loan, the commission is paid. The transaction is fully complete. Why invest the time, the compute power, the software licensing fees, and the human capital to constantly monitor bond yields for past clients? The check already cleared. Their job is technically done, right?
This raises an important question about customer acquisition cost and the lifetime value of a client. The traditional real estate model is hyper-transactional.
Very much so.
You spend massive amounts of money on marketing, billboards, internet leads just to acquire a single buyer, close the deal, and move on. But Village Mortgage relies on a completely different ecosystem. By utilizing automated surveillance to track rates for past clients, the broker guarantees their own future pipeline.
Oh, I see. When Arnold needed to refinance, he didn't go onto Google to search for a new broker. His original broker just materialized in his inbox with the math already solved.
Exactly. It eliminates the competition entirely.
That's brilliant.
And beyond capturing the refinance business, this level of proactive care generates an unstoppable, self-sustaining referral engine. Look at the review from Sharon H. in Fullerton. She came to Village Mortgage via a direct recommendation from a friend who was a real estate agent.
And real estate agents are fiercely protective of their networks. They will only refer a mortgage broker who makes them look like a genius to their buyer.
Without a doubt.
If a broker can consistently pull off 15-day or 21-day closings without the deal blowing up at the 11th hour, the agent is going to feed them every single client they get. They aren't spending capital on billboards. They are spending energy on their existing database, which yields a drastically higher return on investment. The exceptional service itself becomes the marketing arm of the company.
Well said. But having 100 lenders, 24/7 availability, and automated rate surveillance is just a phenomenal operational setup. All of those systems are entirely useless if the broker doesn't possess the actual financial inventory to plug into them.
Which brings us to the actual loan products outlined on the Village Mortgage website. The sheer variety of what they offer is staggering.
It really is an extensive toolkit.
You have the standard tools everyone knows: conventional loans, FHA loans, jumbo loans for high-cost markets, ELOCs, home equity loans, and reverse mortgages. But then they advertise a secondary tier of highly specialized complex investor tools. They list DSCR loans, fix and flips, non-QM loans, and stated income loans.
It is a comprehensive suite of financial leverage.
Let's break down exactly what some of these are, because they completely change the rules of real estate investment. Take DSCR, which stands for Debt Service Coverage Ratio.
Right.
If you go to a normal bank for a mortgage, they look at your personal W-2 income, your personal debt, and your personal salary to see if you can afford the monthly payment. A DSCR loan completely detaches your personal salary from the equation.
Which is a game changer for investors.
Totally. The underwriter only looks at the property itself. If the monthly rent generated by the property covers the monthly mortgage payment, basically, if the ratio is above 1.0, you get the loan. You could have just lost your day job, but if the asset pays for itself, the broker can fund it.
Non-QM, or non-qualified mortgages, operate on a similar alternative logic. They are designed for self-employed borrowers or gig economy workers whose tax returns might show massive deductions, making their official net income look artificially low to a traditional bank.
Right, because business owners write everything off.
Exactly. So non-QM loans allow the broker to use 12 to 24 months of actual bank statements to prove cash flow, rather than relying on tax returns.
It's like a massive Swiss Army knife. But my question is, why does a regular home buyer need a broker with all these exotic tools?
What do you mean?
Well, look at Ricky Y from Chula Vista. He left a glowing review as a first-time home buyer. If I am Ricky and I am already terrified of the process, seeing a giant list of acronyms like DSCR and non-QM on a website isn't a selling point. It's incredibly intimidating. Wouldn't a streamlined, simple broker be better for a first-time buyer?
It would be intimidating if the broker simply handed the client a menu and asked them to choose. But the value of a broker with an expansive inventory is their ability to act as a financial translator.
A translator.
Yes. Ricky specifically noted in his review that Timothy explained all the intricate details of the ever-changing rate environment without applying any sales pressure. The broker absorbs the complexity of the acronyms and simply presents the optimal path forward.
Okay, but that doesn't explain why Ricky needs the investor tools at his disposal in the first place.
To understand why a first-time buyer benefits from an investor-grade broker, we need to completely discard the metaphor of a mortgage being a single tool. It is not a single tool. It is a financial staircase.
Okay, walk me through the staircase.
Look closely at the review from Jenny L. She was buying a standard single-family home, but she explicitly noted that Timothy shared his deeper market expertise to help them become better homeowners and future landlords.
Oh, wow. Future landlords?
Right. The broker isn't just looking at the 30-day escrow window. They're looking 10 years down the client's financial timeline.
I see. So the relationship scales with your financial maturity.
Exactly. When you are a nervous, overwhelmed first-time buyer, you are standing on the very first step. The broker uses a simple, highly regulated tool like an FHA or conventional loan to get you onto the staircase. You live in the house, you pay down the principal, and the market appreciates. 5 years later, you have built substantial equity.
And now you want to move up to the next step.
You want to buy a dedicated rental property or maybe attempt a fix and flip. Because you are already partnered with Village Mortgage, you don't need to go out and audition a brand new financial team.
You already trust them.
Exactly. Your existing broker, who already knows your entire financial history and risk tolerance, simply reaches into their inventory and pulls out the DSCR or the non-QM loan to build that second step for you. The products are designed to be sequenced over a lifetime of wealth building.
So what does this all mean? If we zoom out and look at the entire architecture we've deconstructed today, Village Mortgage and Timothy Joe haven't built a flawless 5-star reputation in Glendora simply by having access to good interest rates.
Not at all.
They've built an impenetrable moat by combining the massive institutional leverage of 100 different wholesale lenders with hyper-personalized 24/7 localized availability. And they back that up with proactive rate monitoring technology that treats the client as a lifelong partner on a financial staircase rather than just a one-time transactional paycheck.
They have essentially weaponized empathy and operational efficiency to protect the client from the inherent chaos of the real estate market.
As we wrap up this deep dive, there is a fascinating forward-looking angle to consider here. We live in a world that is rapidly being eaten by artificial intelligence. Within the next few years, algorithms will be able to monitor bond yields, track local compliance codes like SB 326, and automatically execute refinance documents with zero human intervention.
Oh, for sure. It's coming.
The proactive technology we discussed today will eventually become entirely commoditized by AI.
Which means the ultimate mortgage firm of the future won't be human versus machine. The AI will handle the 24/7 rate surveillance flawlessly, operating the 100-lender network at light speed.
Right.
This will leave the elite human broker entirely free to do the one thing computers will never be able to do, and that is manage the sheer visceral terror of a human being taking on $500,000 in debt.
That's a profound thought. The ultimate luxury in personal finance won't be the algorithm that found the rate. It will be the human being who answers the phone at 10:35 p.m. on a Thursday to tell you that the math works, the contract is sound, and your future is secure. Something to keep in mind the next time you are staring down a massive financial milestone. Thank you for taking this deep dive with us, and we will catch you on the next one.